This is a limited series of the Rational Reminder podcast, a weekly reality check on sensible investing and financial decision-making focused on cryptocurrencies. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
And yes, we are still two Canadians, and yes, we're trying to learn what we can about the world of cryptocurrencies. And this is the second episode in this special series, and we welcomed incredible guest, Dr. Igor Makarov, who is the Associate Professor of Finance at London School of Economics. So I've got to tell us the backstory, Ben.
Igor's written a handful of phenomenally good papers on Bitcoin and DeFi and crypto markets in general. So I found those papers when I was trying to learn about this topic, and I read some of them. One of them hadn't been released yet when I decided I wanted to see if Dr. Makarov would come on our podcast. So I sent him an email. He agreed to come on, and then around the same time, after I emailed him though, he had released a new paper on DeFi for Brookings. So we talked about that during this conversation, but it's phenomenally good information. He's done in-depth analysis of the Bitcoin blockchain to understand what's really going on underneath, like who are the entities involved? Is it institutions? Is it individuals? What's driving the transaction volume? How much of the activity is economically meaningful? How concentrated is mining power? Like all this fascinating stuff. Mm-hmm. That's the paper on is blockchain analysis of the Bitcoin market, I think it's called. And then the more recent paper on DeFi just has a whole bunch of fascinating commentary and comparisons between what a DeFi system could look like and how that compares to the existing traditional financial system. But it's he is an economist. He's got his PhD in finance from MIT, and he's clearly brilliant as an economist. So his perspective on the work that he's done specifically on digging into the Bitcoin blockchain, but also just his economic thinking around these systems in general, I find to be fascinating, but also very, very important for anybody that's interested in learning about these topics.
I agree. I think that was the perfect setup. So with that, let's go to our conversation with Dr. Igor Makarov.
Dr. Igor Makarov, welcome to the Rational Reminder podcast.
Well, thank you. Thank you, Benjamin, for having me.
Igor, what role do intermediaries play in the traditional financial system?
Intermediaries perform many important functions. To name just a few, they help allocate resources to their most productive use. They also provide efficient means of transferring wealth from people with surpluses to those with deficits. And they also help transfer wealth across time and states. Often intermediaries exist to alleviate important frictions in financial markets, such as asymmetric information, adverse selection, and moral hazard. They're not always successful at that because intermediaries themselves are subject to the same frictions. And so the important question is whether intermediaries help create more efficient financial system and how we can structure and regulate them to achieve this goal.
So are the economic rents that intermediaries collect unwarranted?
It's an important but difficult question. Certainly, there are areas where I feel intermediaries' fees are excessive. And just to give you one example, even today we see that many banks charge very high fees when we try, say, swap British pounds for the US dollars. Banks often charge 1-2%, irrespective of the size of the transaction. And these transactions entail very little risk for banks because they can hedge these transactions with the foreign exchange market. So the fees are excessive, but to say that these are excessive rents, that might be difficult because it might be that these fees are used to cover some other costs, for example, bricks and mortar costs. I think it's fair to say that in general, we recognize that intermediaries are in a position to charge excessive fees and earn excessive rents. And for this reason, they are subject to a wide set of regulations. But to say in any particular case whether fees are excessive or not, it's not so easy because it's all about the level of rents. We know that we should leave some rents because rents are important for firms to innovate and invest in new technologies. Also, intermediaries are charged with a number of important societal goals. If we talk, for example, about banks, it's not just to earn profit, but we also want banks to safeguard access to the financial system. We want them to comply with anti-money laundering laws. We want them to check KYC, know your customer norms. And of course, this is a costly activity, and usually it is the banks that carry or bear these costs. So for banks to have incentive to comply with regulation, we also need to leave them some rents. So it's always a question about the level of the rents, right? And then we need to decide whether it's excessive or not. That's not so easy.
Well, one of the things that I've seen DeFi and maybe crypto more generally take aim at is the fees, the level of fees and costs in the traditional financial system. Does the type of decentralized financial system that we see crypto enthusiasts kind of promoting, does that eliminate rents in the system?
I think the answer would be not necessarily. And here we need to step back and ask ourselves, well, in what circumstances we can expect excessive rents or essentially not excessive rents, right? And if we think about excessive rents, usually a sign of limited competition. And competition can be limited for a number of factors. The usual factors are some barriers to entry, asymmetric information, switching costs, some network externalities. So now, if we think about decentralized finance, so the premise that, well, we have an open access system, permissionless protocols, anyone can participate, so the rents should be dissipated. But free entry is not synonymous to more competition, because there could be some endogenous barriers to competition, right? That comes from these factors. And what we show in our recent paper that we wrote for Brookings Papers on Economic Activity Conference, which is available as an NBR paper and as a SRN network, that there are several natural points in decentralized finance where rents can be accumulated. I'm not going to go through the whole list of these points, but just to give you some example. So first, rents can be accumulated at the level of protocols like Ethereum. And the reason the rents can be accumulated there are very similar to what we observe in the case of Visa or MasterCard's network. Here we see some strong network externalities. Developers are more likely to develop their applications for a network where already there are a lot of customers. Also, customers are more likely to join a network where there are a lot of applications. And so already established networks, therefore, can charge potentially high fees, and smaller networks will find difficult to compete with these large networks. An additional complication here is that the security of the networks also very often is linked to the network size, be it like in proof of work protocol, like in Bitcoin, or proof of stake protocol, like that Ethereum is now moving towards. So in both protocols, larger networks are usually more secure, and therefore smaller networks or potentially rival networks might find difficult time to compete with these networks. Just to give you another example, we can think about decentralized exchanges. So here, similar to centralized exchanges, size matters. So if we have large exchange, then large exchanges usually have significantly higher liquidity. And as a result, large exchanges can charge higher fees compared to small exchanges, and small exchanges would find a difficult time competing with large exchanges. So similar mechanism as in the traditional financial system work in decentralized finance or in this crypto space, and therefore we in general should expect that rents will be accumulated at different points or in different levels of this system unless we put some regulation. Yeah.
Are the rents higher? Like I've messed around a little bit on the Ethereum blockchain, and the fees to do anything are crazy.
Yes, right now, the fees, I've been also surprised when I looked at the level of the fees. Last year, we have the numbers, Ethereum collected about $10 billion in fees, and that's compared to Visa network of, I guess these were like $24 billion, but that's in revenues, not just in fees. So if we look at the fees per transaction, Ethereum fees were 100 times that of transactions in the Visa network. Having said this, it is true that people recognize that proof of work protocols are expensive because of all the expenditures that we need to spend on electricity, and that's the reason behind the push to move to proof of stake protocols, which supposed to be cheaper, and we already see that some networks that moved to proof of stake protocol or started as a proof of stake protocol, there the fees are smaller, but again, it doesn't mean that in the future the fees will stay small or they would be at the lowest possible level. It could be the case that once the network is large and important, then it might choose to charge, say, fees which are above the marginal costs.
Yeah, that's super interesting. In Satoshi Nakamoto, the pseudonymous Satoshi Nakamoto's early writings on Bitcoin, they wrote that, this is a quote, "Banks must be trusted to hold our money and transfer it electronically, but they lend it out in waves of credit bubbles with barely a fraction in reserve." In the traditional banking system, how much of a problem is the type of systemic risk that Nakamoto was worried about?
I think here it would be fair to say that we give banks our money not just to hold them. We want actually to earn some return, right? So holding money would be quite a straightforward problem to solve. So what is difficult to solve is that if we want to make our money work well for us, say, or in general in the financial system, so that kind of goes back to one of the functions of the financial system is that we want to allocate resources to the best possible use, right? So, and we as a savers, we have some excess of liquidity, and we want to give this liquidity to, say, firms or other people who have good ideas and can invest these resources for us. So in that sense, it's almost to the extent that future is uncertain, to the extent that we do not perfectly know which projects are good or bad, right? Because it depends on so many factors, right? So the information which we need to take into account while making these decisions is spread across many people in the economy. We need to aggregate all this information and then again to go through possibly different views on what is a good technology, what is a bad technology, right? So that's what makes this problem quite difficult. And we should expect that we make sometimes mistakes. So the loans that, say, banks as intermediaries make, they're not perfectly safe. So as a result, there could be some states of the world where banks make some losses. Of course, what we want again the best or most efficient system possible, right? So we want to minimize those mistakes, but we need to recognize that the problem is really difficult. So it's impossible to solve completely this problem.
So does solving the systemic risk problem in the way that Bitcoin and DeFi propose improve banking?
Well, I think here we are not yet there. It's not that they propose to solve the systemic risk problem. I wouldn't say so, because right now they operate under what we call narrow banking mandate, where if people would like to borrow, say, some coins, they have to post collateral, which is even in excess of the amount of what they want to borrow. So clearly we can see that it might serve some investors, for example, if investors want to take some leverage, etc. But a lot of people in traditional financial systems are not in a position to borrow some funds and put some liquid collateral. So those people usually just don't have actually liquid assets to put as a collateral to begin with. That's one of the frictions, right? People have some labor income, but that happens to be in the future. And then the question is, well, how can we borrow against this future labor income, which is not liquid, which is not tradable? That's what makes the problem difficult in a way. So far, what we see in the DeFi space, that it's largely abstracted from this really difficult problem, but at the same time, the problems that is important for a very large part of population, especially those who are maybe in most need for resources or funds and would like to borrow against future. While even there, we see some problems, but I think we'll touch upon those problems a bit later.
So some of the things that we hear a lot about with blockchain is trustless, that it's trustless, or that code is law. Can a blockchain or DeFi ecosystem exist without human intervention?
I think that's a really good question, and that really depends what we mean by without human intervention. If we mean whether smart contracts can be executed without human intervention in an automatic fashion, sure, we can write those smart contracts. But if we ask a somewhat maybe more relevant question and interesting question, whether the system can, for example, function without any recourse to legal system, or whether the system can, whether we can automate the investment process. And I think very quickly we can kind of get to the conclusion that, well, that's probably not possible, right? Because no system is perfect. So, and even if it's perfect at a particular point in time, then it doesn't mean that, say, 1 year, 5 years from now, the system would be as efficient as, or maximum efficient from the point of view of some new technology, etc. So we would need to make some changes. So once we need to make some changes, we would need to rely on humans to make those decisions, right? What kind of protocols we want to adopt. Also, if, again, we see a lot of problems with even smart contracts, right? Smart contracts, we need, because for smart contracts to execute without any human interaction, this must be a complete contract, as we say in economics, where we envision all possible states of the world and we say what should happen in every possible state of the world, which is costly, right? So for this reason, very often in the real world, we leave some contracts incomplete, and then we also allow ourselves to resort to the legal system, so to effectively complete those incomplete contracts. And that could be cheaper than writing a very, very complete contract where we envision all possible states of the world. Yeah.
Would decentralized autonomous organizations improve governance compared to the existing financial system?
That's another important question, and the short answer would be unlikely. The reason being is that the governance problems in DeFi space are very similar to what we see in the normal corporate space. So here we also have different types of stakeholders. These are developers, validators or miners, users, investors. The interest of these different types of investors are not necessarily aligned, right? For example, if we think about users, users generally prefer lowest possible fees, but validators might, for example, like higher fees. So we need some set of rules, and we usually call it governance rules, that ensures that different types of investors don't fight with each other, that investments are made in the efficient way, and also that minority stakeholders are not expropriated by some powerful insiders. So, but in terms of economics, the same frictions that apply in the corporate world and in crypto space are very similar. And what we have like huge amount of academic research that studied corporate governance, what rules make governance essentially good corporate governance, what rules don't work. And while governance rules are somewhat different across different countries, it's almost uniformly accepted truth that for good corporate governance, we need to resort to the legal system. Usually market mechanisms alone will not solve the problem. So, because again, incentives may not be enough. Sometimes we need to go after people who make bad decisions and punish those agents. So, but if you think about this resorting to the legal system, it goes against the maxim of decentralized finance, which says that, well, we should not trust to anyone, right? We should rely to essentially trustless trust system. And that's what makes, at least that's why I think that this experimentation with decentralized governance, while interesting, but at the end, it will converge to the conclusions that we make in the traditional financial system, that we probably would still need to resort to the legal system. And in that sense, it would be very similar solutions that we have in traditional firms.
One of the things that we're going to talk about later is the concentration of ownership and mining in Bitcoin specifically. Does that type of concentration cause problems for governance in DeFi?
Yeah, it could. For example, to give you maybe just a simple example, think about, we have miners in Bitcoin, and this is a proof of work protocol. And it's based on the idea that miners have to solve some difficult mathematical problem, and for this they invest in expensive hardware, right? And hardware is very specialized, so it designed to solve one particular problem. So we might think that, well, actually this protocol, for example, is not very efficient, and we would like to move to more efficient protocols, right? Because Bitcoin, we know that it cannot process a lot of transactions, it's relatively slow, so we might think that, well, maybe it's good to have something else. But from the point of view of miners, who already invested a lot of resources in the hardware, right? So they incurred a lot of fixed costs. So this move would destroy some of the investments, and therefore it would not be necessarily in their interest. And so naturally they can resist the move. And again, of course, if every miner is small and doesn't have any power, maybe again, it would be easier to persuade the community to move to the new protocol. But once we have just very few powerful insiders, then this move could be more difficult to accomplish, because they can, say, collude with each other and block those investments. And that's not just a fictitious story. We have some accounts that indeed some wars, or kind of maybe not wars, but at least this kind of fights did happen among Bitcoin miners and people who were in charge of Bitcoin protocol.
Yeah, it's super interesting to think about. Where do you see opportunities for crypto and DeFi to improve the existing financial system?
Right. I think it's also an important, but not an easy question. That's almost like, I'm not even sure if it's $1 billion question. It could be multi-billion-dollar question. That's what the industry tries to find out. I think the underlying distributed ledger technology holds lots of promises. It can reduce transaction costs, shorten. That's the underlying ledger technology. It has the potential to reduce some important transaction costs, and that includes, for example, shortening settlement time. It also can make the system less fragile and prevent, for example, to increase the resilience to some particular failures. Usually people talk about cryptocurrencies or decentralized finance when they say, well, improve over the traditional system. That's where we need to be a little bit more precise, right? So what do we mean by decentralized finance? And usually when people talk about decentralized finance, they mean a system which is based on permissionless protocols and where the access is anonymous and unrestricted. So if we are to adopt that definition of DeFi, then I would say here the question becomes less clear, because if we compare this system with a system where, say, validators, there are still a lot of them, but we supervise those validators, for example, and if we have, say, different countries allow a certain number of validators, right? So it's not even one country that controls the network, so it's quite distributed. But nevertheless, still, we know who validators are, and if necessary, we kind of go after them if they misbehave and do wrong things. So if we compare these two systems, then it becomes less clear that this permissionless anonymous system actually would be significantly more efficient compared to the system where we have some control over developers. We know who they are, and we can impose some constraints on them or on validators so that they don't misbehave. So in that sense, it was a long conversation, but ultimately, I think comparing these two systems, it becomes less clear whether the current design will be able to significantly improve upon the traditional system. It certainly pushes the traditional intermediaries to be more efficient, and we can see that now they adopt new technology, which makes transaction fees lower, and again, more linear, but so far we haven't seen that they solved problems which the traditional financial system couldn't solve. Yeah.
So you were talking about like a permissioned distributed ledger system. Is that right just now?
We can call it this way. I think in a way it depends really also what is a permissioned, right? So if we call permissioned any system where we know who validators are, yes, and that's what I call permission financial system. But in some sense, we can envision a system where, for example, the number of validators is not a constant. So we allow almost anyone who wants to be a validator enter and be a validator. It's just that they would be subject to some regulation. And if we think about some other societal functions, right, for example, enforcing KYC norms and or anti-money laundering laws, then we can see how that system might be more efficient than the existing system, right? Because with a permissioned network, we can mandate validators with processing transactions that only come from sort of verified or certified users. They don't necessarily need to know who stands behind particular cryptocurrency addresses. They just need to know that those addresses are certified, right? And we would have some agencies that would provide the link between the certified addresses and particular individuals like digital ID, etc., right? So while in the current design, this function in particular is very difficult to achieve.
Okay, that is interesting. So that's like a way of enforcing KYC protocols, for example, by requiring people to adhere to certain things to participate in the network. Mm-hmm. Is that right?
Yes.
Huh. Yeah. Okay. That's interesting.
Why is it important to understand the Bitcoin ecosystem?
Oh, Bitcoin is the oldest and still by far the largest cryptocurrency. And it's often seen as a barometer for the whole crypto space. We can see that many products are first offered essentially in the Bitcoin space. Think about futures, think about ETFs or pension system. And Bitcoin also was the first cryptocurrency to be adopted as a legal tender, right, in El Salvador. So it's quite natural to look what's going on in Bitcoin and understand the problem, because again, it's almost half of the market capitalization of the whole crypto space.
What are the limitations of understanding the Bitcoin ecosystem?
So the main problem comes from this anonymous and unrestricted access. As you know, the way Bitcoins are stored, they're stored in Bitcoin addresses, which are just alphanumeric strings protected by cryptography algorithms. If we step back and think about how traditional financial system works, right, we have centralized intermediaries, which are charged with safeguarding the access to the financial system. And they achieve this goal by collecting and protecting personal information. Cryptocurrencies, in contrast, they protect privacy by not collecting this information. So as a result, we really don't know who stands behind those crypto, say, for example, Bitcoin addresses, right? And decentralized finance, while Bitcoin protocol is not particularly well suited for decentralized finance, but say protocols like Ethereum, where we have smart contracts, they actually make or shift the balance in favor of personal privacy even more, because there in the Bitcoin space, we have centralized exchanges and a lot of centralized intermediaries that can do KYC checks. And a lot of them actually are charged with these functions now. But in decentralized finance world, we have now decentralized exchanges where you can completely bypass KYC checks and say, for example, trade with other people using smart contracts, right? So in this world, it becomes really difficult to, for example, to understand whether we trade with some sanctioned entity or not. and also enforcing taxes becomes quite difficult, right? In the centralized, when we talk about, say, exchanges see how we trade. They can keep track of our trades and provide reports to IRS and also to tell us, well, you realized such and such profit. Again, with decentralized exchange, when we don't really know even who trades, and for example, it's just tracing all transactions kind of along the long chain, it becomes quite a difficult problem. So these are the problems.
How did you associate Bitcoin addresses with real-world entities?
So there are essentially three ways, but only two ways are practical, accessible for researchers. First, some people post their Bitcoin addresses on the web. So by scraping cryptocurrency blocks, we can link people and those addresses. The second way is that we can interact with real world entities. Think about exchanges. When we send Bitcoins to an exchange, the exchange provides us with a particular Bitcoin address where we need to send our Bitcoins to. So by collecting this address and then using clustering algorithms, we can find addresses which belong to a particular exchange. And kind of we can repeat this, or we can apply these methods to other entities. For example, if it's a marketplace, the marketplace would again provide us with a particular exchange where we need to send, say, Bitcoins if we want to buy particular goods. So finally, the third way is that when people, say, interact with an entity that enforces KYC norms, for example, exchanges, right? Then the exchange, because it enforces know your customer norm, they can link addresses that kind of the exchange knows an address where I sent my Bitcoins from, and it can make this correspondence. But that's usually private information of the exchange, which is not available to researchers, but this information might be available to regulators if this exchange is regulated and in the jurisdiction, which is kind of in the domain of regulators. So these are the three main methods.
And this is all in your paper, blockchain analysis of the Bitcoin market, if just so listeners know what we're talking about here. In that paper, how did you differentiate between addresses belonging to individual investors and those belonging to intermediaries, like the exchanges you were just talking about?
Yeah, it's a good question. So first, why we would like to differentiate between intermediary and individual addresses. And here, what we are after is to understand the concentration of Bitcoin holdings. The problem is that when investors send their Bitcoins to an exchange, they forfeit the ownership of their Bitcoins to the exchange. And then the exchange usually collects all Bitcoins and mix them together and stores in a so-called cold wallet. These are the Bitcoin addresses stored on a particular device, disconnected from the internet for security purposes. So if we see Bitcoins in this cold wallet, right, this is an aggregate claim on Bitcoins of many people. So if we...
Can I just ask a quick question? So when people are sending their Bitcoins to an exchange, that individual no longer owns their own Bitcoin on the blockchain. They're trusting a centralized exchange to keep an account of the Bitcoin that they've deposited. Is that right?
That's correct.
Okay.
So, and that's kind of one of the selling points of decentralized exchanges, because with decentralized exchanges, you don't need to give up the ownership. You're always in control. And then transaction, if it's executed, you just swap the ownership of one coin for another coin. But that's not what's going on with centralized exchanges. The exchanges keep their own record of who owns what, and also this record is adjusted based on your trading behavior. Pretty much the same way as it happens in other centralized.
Right. I was going to say that sounds a lot like a regular exchange.
Yeah, okay. They are regular exchanges. So it's just that we deal with once Bitcoins we send them to a centralized exchange. It's exactly the same. It's indistinguishable from any other trading instruments. Yeah. So now coming back. So if we want to understand the concentration of Bitcoin ownership, well, we cannot do much about holdings within exchanges because we don't see who the ownership of Bitcoins within the exchange. The exchange has this information, but we do not. So therefore, what we do in our paper, we try to only look at individual holdings of Bitcoins outside exchanges or other large intermediaries. And for this reason, we would like to separate these two groups. So how do we do this? And the general idea is that accounts of exchanges or other intermediaries, they should be more active compared to individual accounts, with a caveat that cold wallets might look also similar to individual accounts. So we need to be very careful not to confuse cold wallets of exchanges or other intermediaries with individual accounts. So how do we do this? So for this, we essentially follow two steps. In the first method, we scrutinize addresses with very large Bitcoin balances, the so-called Bitcoin rich list. So any address with more or cluster of addresses with more than 1,000 Bitcoins. And then we first check whether it belongs to a known intermediary, and we have a kind of a large set of known intermediaries. So if it doesn't belong, then what we do, we build a network of clusters that interact with this particular address. Because again, the worry is that it might be a cold wallet, and we would like to see whether it's linked again to any clusters that possibly look like intermediaries. And again, we do quite careful analysis. It takes quite a lot of time. We try to automate it, but not everything can be automated. So quite in difficult cases, we have to examine it by hand, manually, and kind of to see whether it really looks like an individual account or intermediary account. And we try to be here quite conservative because, again, what we want essentially a measure of kind of to preview the result will show that concentration is really high. And therefore, we rather would like to make a mistake misclassifying some individual addresses as intermediary addresses, but not vice versa. For example, if we have a whale, an investor with very large holdings on the exchange, and this investor takes out Bitcoins from the exchange, then in some cases, we can actually misclassify this whale investor as kind of address that intermediary address because it would have a link to the exchange. Yeah. Mm-hmm. But again, we do so that to be conservative in our estimate of concentration of individual holdings. And then, so this is kind of one method. And the other method, because we cannot kind of scrutinize all addresses in the network because there are more than 600 million of these addresses. So what we do, we for smaller addresses, kind of with smaller balances, we have a rule of thumb that if particular cluster of addresses was not active for a year prior to where we look at the concentration, then we deem these clusters or addresses as belonging to individual investors because, again, intermediaries are more likely to interact with these clusters. So that's what we do.
So fascinating. How did you gain an understanding of what Bitcoin's actually used for?
But here, I think it's good to step back and ask what makes a cryptocurrency valuable, right? Where does the value come from? And here, well, first, a cryptocurrency, if it's used as a transaction medium, can also attain some value, similar like to money, right? So if that's the case, we should see that Bitcoin, and if we would see Bitcoin flows to some marketplaces, be it legal marketplaces or legitimate marketplaces, we also can see that flow of Bitcoins to what is called payment processors. These are, again, special entities that process payments, say, for example, for some websites, etc., or ATMs. Yeah. So that's number one. Number two, well, if Bitcoin is used as a store of value, well, but if that's the primary kind of essentially use of Bitcoin, in principle, we should not see a lot of trading volume, right? Because people would just occasionally buy Bitcoin and hold it. Yeah. So finally, the third reason could be just a speculative motive, right? If people not just hold Bitcoin, but they try actively to predict what will happen to Bitcoin price in the next moment, and based on their expectations, they would either kind of increase their position or decrease their position. So, and in the third case, we should expect to see a lot of volume kind of to exchanges, from exchanges, and a lot of volume on exchanges, if that's the case. And that's what we find in the data.
How large of a role do the exchanges play in the total volume of Bitcoin transactions?
So we estimate that that exchanges and over-the-counter trading desks, they account for roughly about 75% of what we call off-chain Bitcoin volume, right? That's the volume which is recorded on the blockchain. So this volume, these are kind of, we can see this volume when people move their Bitcoins from their private wallets to an exchange, and essentially from an exchange. And also when people send from one exchange to another exchange. Yeah. So there is also off-chain volume. Did I say, by the way, off-chain or on-chain? So I might have confused. So in the first case, we were talking about on-chain volume, the one which is recorded on the blockchain, right? So off-chain volume is the one that happens on centralized exchanges, the one which we do not see on the blockchain itself. It's just, we have normal limit order books, and then exchanges cross volume on this order book. So what we show in the paper, kind of, we mostly analyze on-chain volume, the volume on the blockchain, but we show that exchange volume on the blockchain, while it's smaller than off-chain volume on exchanges, but it's comparable to that volume, and also correlates quite highly with this volume. So in a way, our results suggest that essentially when people move their Bitcoins to an exchange, it's an indication that they are more likely to trade quite soon on the exchange. And in principle, that again, this is a motive for holding Bitcoin, that the speculative kind of motive is important.
So just to be clear, was that 75% of on-chain volume is through exchanges? Wow, okay. That's a lot.
Other than transaction volume, how important are exchanges to the network?
Well, exchanges are important, right? Because especially in the Bitcoin network, exchanges are centralized. Almost all of them are centralized, and these are the points of entry and exit of funds to the network. So, whenever people would like to buy extra Bitcoins, they would need to send, in most cases, their funds to one of the exchanges, or again, OTC trading desk, and that's how they buy or how they cash out their Bitcoin. So they play a really central role, I think, in this ecosystem.
We touched on earlier the idea of permission systems that could help enforce KYC in a global financial system, which is a pretty cool idea. Practically speaking, for Bitcoin, what are the challenges in enforcing KYC and AML rules for the crypto ecosystem?
Yeah, so here I would actually probably make a distinction between the Bitcoin system and, say, Ethereum, which allows also decentralized finance solutions. And the distinction is not completely black and white, because Bitcoin also develops some solution that allows to run some decentralized applications. But again, right now, if we think about that, Bitcoin mostly is centered on centralized, say, exchanges and centralized intermediaries. There, in principle, if we regulate all exchanges and all exchanges adhere to strict KYC norms, right? So we would have something that looks very similar to the traditional financial system, where we have centralized intermediaries, and then the Bitcoin protocol works like as a glue, like as a payment system that connects different intermediaries. So we can replicate that system. The problems come that not all exchanges are usually, like, they're not all regulated, or at least some of them are in offshore areas and only lightly regulated, so they may not adhere to the same strict norms, KYC norms. So if that's the case, right, then we have some potential entry nodes where some illegal money can enter the system. So, but if we now kind of think about more about decentralized finance, right, that's where the real problems come. So because there we have decentralized exchanges, for example, so people can easily trade on those exchanges, and then it's very difficult to know, right, whether we trade against a sanctioned entity or even to trace all the transactions to calculate taxes. So, and what really matters then, it's also the adoption of cryptocurrencies, because if we have a very wide adoption, right, we might envision a system, and that's, I guess, what people kind of, when they talk about adoption, they envision that, for example, cryptocurrencies can be used not just for trading, but also to buy some goods. So then, if we contrast again these two systems, right, in the traditional system, we have the centralized intermediaries that kind of control who enters and leaves, how money kind of enters the system, right? And the benefit of the system is that we need to do checks only at a limited number of these nodes, right? So when we go to a shop, if we use a credit card issued by kind of a certified bank, we know that these are already clean money. We don't need to worry. While if we don't have those agents who would kind of safeguard the entry to the system, right? That's kind of what currently how the decentralized finance works. Then we run into a problem, because I have some cryptocurrency, right? And I would like to buy some good, but then what is it the shop that kind of needs to check whether this essentially the source of my funds legal, not legal? It becomes a really complicated problem.
Interesting. That sounds like an enforcement problem, but it also sounds like it could be a fungibility problem. Is that accurate? Like if fungibility, like if a cryptocurrency has a history attached to it where it came from a sanctioned area or something like that, and that could affect whether it's accepted.
Yeah, I mean, you see, like we all like, it's quite popular to say that, oh, because we have digital footprint, because we can trace all the transactions on the network, we effectively can maybe eliminate illegal transactions or be able to go after the offenders. The problem is that it becomes quite difficult to implement because we would need to trace along potentially very long route, but also this tracing only bites if we can identify who is behind this particular chain of addresses, right?
Mm-hmm.
So, but if, for example, we can use our cryptocurrencies to pay for goods, right? And then a particular store doesn't check because it's probably impractical. Imagine that a store would have to go and go through all the potential chain for each customer, right? Then it would be a really difficult problem. Somebody would have to do this in the system. And again, currently, the current design of most cryptocurrency ecosystem is that essentially nobody checks the entry, and that introduces many problems.
So we touched on centralized and decentralized exchanges. Are the most important cryptocurrency exchanges generally decentralized?
No, right now we're still in a world where the largest exchanges are centralized. These are Binance or the Coinbase. But again, these different exchanges, they're subject to different level of regulation. Exchanges which are in the US, like Coinbase, they are more regulated compared to exchanges which are in some offshore areas like Binance.
What portion of Bitcoin transactions would you consider to be economically meaningful transactions?
Yeah, here I think it depends what we mean by economically meaningful transactions. In the paper, we treat any transactions where the ownership of Bitcoin changes as meaningful. And this includes, for example, trading. So if I own some Bitcoin and I sell it to you, that would be a meaningful transaction. We estimate that about 10% of all nominal volume on the Bitcoin blockchain as a meaningful transaction, and the rest being some, what we call some superfluous volume or fictitious volume. These are the transactions where the same entity essentially just moves funds between accounts that it controls. It's the same as if I take some Bitcoins from my left pocket and put it into the right pocket. So those transactions we don't treat as meaningful because there is no change of ownership.
Why are all of those changing from one pocket to the other transactions happening?
That's because two main reasons. One is structure of the Bitcoin protocol. So the way it works is that to understand what is the current balance in a particular account, we need to trace all the transactions that involve this particular account. And then suppose somebody at some point sent 1,000 of Bitcoin to a particular address. So if we would like to make a payment of just one Bitcoin, then actually the Bitcoin protocol is structured so that we have to send the whole balance that we received in the past and then collect the change. So what we would see is that, again, one address would receive one Bitcoin, and then the other address, which either the same address or newly created address, but again, that would belong to the same party, would hold 999 Bitcoins. So that's one reason. The other reason is the so-called no address reuse like the Bitcoin protocol, because of anonymity concerns, because of this potential traceability, the Bitcoin protocol encourages users not to reuse the same address more than once. So many wallets, therefore, are programmed in a way that when we send our money, or our Bitcoins, then we would kind of generate new addresses in every kind of transaction. And as a result, what we see is a long chain, what is known as a peeling chain, where Bitcoin travels from one address to another address, and so on, and so on, and so on, and so on. So, and again, this is just because we would like to preserve anonymity of the transactions, and that's why we see this type of behavior.
So if 10% of Bitcoin transactions are economically meaningful, do we have information about what those are? Like, is it retail transactions, or like what is it?
Yeah, well, as I said, so out of this 10%, we already touched a little bit, I guess in one of the previous questions, out of this 10%, 75% transactions which are related to exchanges, and some small percentage goes to some illegal activities, or such as darknet marketplaces, or transactions related to spam, or to some ransom. We also see some transactions that go to gambling. We see transactions associated with payment processes, where people use Bitcoin for, again, maybe buy some airline tickets or some exchanges. But those are very, very small fraction of this remaining 10% of Bitcoin volume. So overall, again, majority of volume is linked to exchange volume.
So just to put a finer point on this, how much illegal activity, because this is a common question, is being facilitated by Bitcoin?
Yes, so in our estimates, and if we look at this 10% of meaningful transactions, right, we estimate that only 3% of, yeah, now it's not of the 10%, right? 10% becomes 100%.
Yep. So
the 3% of economically meaningful volume in 2015 was related to illegal activities. By the end of 2020, that number became 0.4%, 40 basis points. But it doesn't mean that illegal activities don't matter. So because the volume also and the price of Bitcoin have been growing over time, right? So we estimate that in 2020, for example, illegal activities were around maybe $1.6 billion. And that's only in Bitcoin. I think firms like Chainalysis or Bitfury, they estimate the illegal activities across all crypto, essentially within the whole crypto space. And the number, if I remember correctly, is about $15 billion. So it's not a trivial amount. It's something that we certainly should be concerned. It's just that as a percentage of the total activity, it's not a large number. So if we think about value of Bitcoin, it's unlikely that value of Bitcoin comes from these illegal activities as a means from those transactions. It's more probably because of investors' desire to speculate in these markets.
There's another paper that I read, 2019 paper by Sean Foley, if I remember correctly, and they found like 46%, I think, of the transaction volume they found to be for illegal uses. Do you know why your number is so much different from theirs?
Yes, of course. That paper received quite a lot of attention, and a lot of people cite this number. There are two main differences. Kind of one is that they intentionally exclude transactions associated with exchanges. So their set of known entities is very different from ours. We have much more precise data. So we can identify significantly more exchanges. They use so-called walletexplorer.com. There, as far as I remember, it's less than 200 exchanges. And most large exchanges like Coinbase or Binance, they're kind of FTX, etc., they're missing. So kind of that's one again. So the exact comparison therefore is difficult, but again, so one thing is that they don't count any transaction associated with exchanges in their calculations, so the base is potentially small. The second important factor is that how they decide which transactions are used or which addresses are used for illegal volume. And what they do, they start with some darknet marketplaces, and then they look at addresses or clusters that interact with these darknet marketplaces. And they say that, oh, if a particular address is kind of receives more than 50% of its flows from this darknet marketplace, then it's also in a legal cluster. And they repeat this classification of clusters kind of in a recursive method. But what kind of we show in this paper is effectively this involves double counting of volume, because they do not remove in their analysis kind of this peeling chain transaction. As I said, right, people try to clean up their Bitcoins that come from illegal marketplaces or that come to marketplaces. And therefore, what we see is that very often a particular Bitcoin would be sent to some addresses. It's not necessarily that the ownership of this Bitcoin changes. It's just that because we want to make it clean, we would mix this particular Bitcoin with some clean Bitcoins. And again, we split now, which is kind of becomes gray Bitcoin into further parts where like one for kind of half goes to another, and we mix it with another clean Bitcoin, and so on and so on and so on. So what they actually count, they count this flow as volume, even though again, it's not necessarily that Bitcoin ownership changes. We just count volume that comes to a particular darknet marketplace, and we think that's the right measure of illegal transactions, or again, the Bitcoin that comes to some other illegal entities.
Okay, you already touched on this next question, but I do want to ask it explicitly. Based on the documented uses that we were just talking about, what do you think is driving the price of Bitcoin?
Yes, that's a good question, an interesting question. I think here it's good to start with some facts about Bitcoin pricing. And actually, it is related to what we did in our earlier paper, which is published in Journal of Financial Economics. So there we showed actually that Bitcoin price is related to assigned net volume. So net buying volume, right? We can see whether it's a buy or sell order. We can calculate what is the net order flow. And what we show in that paper is that actually net order flow explains 80% of variation in the Bitcoin price. This is really a large number. So we see that this number is significantly smaller in other markets like foreign exchange markets or equities markets. And effectively, it means that the news component is small. So it's mostly, the price is mostly driven by investor sentiment. When investors kind of get excited and they start buying Bitcoins, then the price goes up and vice versa. And actually in that paper, we also estimate the price impact. We show that it's quite stable over time, and 10,000 of Bitcoins induce a permanent price impact of about 3 to 4%. So, and that means that whales or investors with kind of that control large amount of wealth play an important role in this market. Just to give you some example, right? We have this MicroStrategy famous stock that they now hold about 130,000 of Bitcoins that they accumulated over the 3 years. So our estimates suggest that actually MicroStrategy alone is responsible for about 40 to 50% appreciation of Bitcoin. So if MicroStrategy is is going to sell their holdings, then actually we would expect a very large Bitcoin price decline, about 40 to 50%. So a lot of systemic risk associated with these guys. So now, I think people are always interested, what will happen in the future, right? So past is the past. So here, I think the future price will really depend on new inflows of capital, because Bitcoin is unproductive asset, right? So it's all about the willingness of people to hold essentially their capital in Bitcoin. And the inflow of new capital will depend on the lobbying efforts to bring serious institutional flows to the system. I think at this point, retail investors who wanted to invest in Bitcoin have already invested. So the question, therefore, it's essentially institutional money is the only untapped resource, at least like on a large scale. And we can see that there are some signs that institutional funds can indeed arrive into the space. Last month, Fidelity announced that they will allow Bitcoin in their 401k plans. Personally, I wouldn't put my retirement savings in Bitcoin. It's true that we can try to speculate on the short-right movement because of this price impact. If we know that a lot of institutions are going to buy, then we know the price will go up. But again, in the long run, I think the price appreciation of Bitcoin is limited because, again, it's tied to the growth rate of aggregate wealth. And again, that's usually not a large number. It's definitely not what we would not support this huge price appreciation of Bitcoin that we have seen in the last 10 years. But again, it will be difficult to, right now, I cannot predict what will happen to this institutional money, whether they will succeed, and if they succeed, whether essentially there will be institution starts putting, say, pension money into Bitcoin. Here again, we might have some concerns, right? For example, because of the price impact, if a manager of a particular fund already has some prior holdings of Bitcoin, right? We can see how his interest could be conflicted, right? Because he or she would know that, well, maybe it's not a good idea to put pension money into Bitcoin, but at the same time, once you know that, well, your own holdings might go up, you might benefit. So, yeah.
Wow. Which is interesting.
Should be concerned, but let me stop at this.
That's we talked to, but before we started really trying to understand. Well, I guess that's not true. We had a few people on our podcast a while ago when we were trying to understand this stuff, and we decided to go a lot deeper, which is why we're talking to you. But we talked to Marco DiMaggio from Harvard, and he told us when he was on that Fidelity has been mining Bitcoin since like the early days. So it would make sense that they have, like you're saying, an interest in increasing the price.
It could be. I was not aware of this fact, but it is consistent.
Yeah.
Let's put it this way.
Yeah, no, that's super interesting. So it sounded like when you're talking about flows and prices, that sounds like Ralph Kojan stuff on price elasticity in stocks. Is that the same kind of thing? Like Bitcoin has an inelastic price?
Well, it's certainly related, and the price impact in the Bitcoin market, I think, is the order of magnitude, or if not 2 order of magnitudes larger compared to what we see in equities. So again, because it's mostly investor sentiment and not so much news. From time to time, we have some news that a particular exchange is hacked, or I don't know, then some regulatory improvement or approval of some particular exchanges, right? So there are news, but they're quite infrequent and not like inequities.
In your paper, how did you identify individual Bitcoin miners?
So a short answer would be that we follow the distribution from pools to individual miners. And here I think would be useful to show a picture we discussed with Benjamin. Most mining is done in pools. That's because the protocol provides incentives for miners to co-insure each other. Because if I'm a small miner, the probability is that I ever win the race and will be able to verify the block and collect the reward is very small. So what miners do, they organize themselves in pools, and then again, they share the reward. And the way pools operate is that they collect this reward in using particular addresses. So very often they would include Bitcoin protocol allows actually to include some text into Bitcoin addresses. So you would see that, oh, this particular block was mined by such and such pool, for example, by end pool. So we would know that this particular address is associated with a particular pool, right? So we can see that, oh, okay, and on this picture, these green addresses, these are the reward collection addresses. That's when pools collect the rewards. So once they collect the block reward, usually what happens is that they accumulate rewards, say, within a day. And then each day, or sometimes twice a day, it depends on how large a pool is, they would distribute these rewards to individual miners. And different pools use different algorithms, and we spent quite a lot of effort understanding those algorithms and kind of go through them. So here you can see what happens in the case of end pools. So once they accumulate rewards, they send these rewards into what we call reward distribution addresses. And I show you in the next picture how it works. So here, for example, we can see that we collected rewards on this address, and then we send to this address. So once funds arrive to this address, what happens is that, so we can see that this reward distribution address receives 100 Bitcoins, and then they start sending it to individual miners. So we can see that this particular miner represented kind of gives its address, and then it receives that amount of Bitcoin, and so on and so on and so on. So because there are so many miners who work for Endpool, Endpool was one of the largest pools and still remains one of the largest pools in the space. So it's not possible to distribute the reward in one transaction. So then we can see that the change is collected in a particular, in a new address, and then this address also kind of continues sending rewards to individual miners. So, and this process actually goes like for many times. Sometimes you have more than 100 distributions. So actually at every step, we distribute more and more rewards until we are done. So what we do, we follow this distribution pattern, and we kind of associate each miner with this Bitcoin address that the miner uses to collect the rewards. And we can see that the same addresses are used repeatedly, kind of from time to time. And we can see how, therefore, we have the reward history of any particular miner overall. Once we remove the smallest miners and leave only those that collect at least $1,000 in total rewards, we have about 240,000 miners going through this process.
That is fascinating. Crazy. You mentioned Antpool being a big mining pool. Are the Bitcoin miners decentralized? And I think it's important to point out that that was part of Satoshi Nakamoto's vision, was this one CPU, one vote, I think. Is that holding true?
Well, I think we know that it's not entirely true. And today we have specialized mining farms that do mining. So what we show is that, as I already mentioned previously, right, that in total we have 240,000 miners at any particular point in time, maybe about 5 to 10,000 miners are active, but the mining power is distributed very unequally. So we show that often as few as 50 miners control 50% of aggregate mining capacity. Again, it's not one miner, not two miners, but quite a few miners. Yes, so, and what we also show that at least before, okay, maybe because you will ask me about concentration and geographical concentration. So let's defer that question to that point, yeah.
So based on the built-in economic incentives, is miner concentration all that surprising?
I think the very fact that mining is done in pool is not surprising, because that's essentially the economics of the Bitcoin protocol. When we started this project and we tried to look at concentration of individual miners, we actually didn't have a good prior what will happen. And I think now with the results, I would say it is surprising. I did not expect it to be so concentrated. But at the same time, some people who may be closer to this industry, they would think that, well, maybe the industry has some increasing returns to scale. Therefore, maybe we should expect miners to be concentrated.
How does the mining concentration vary over time?
So what we show in our paper that concentration depends on the price level of Bitcoin. So whenever price increases and it becomes more profitable to mine Bitcoin, we see the inflow of new miners. So concentration falls, and vice versa when Bitcoin price goes down, or for example, we have the so-called Bitcoin halving events where the reward for mining a block halves, then around those, or like right after those events, we see that concentration increases because a lot of miners leave the space. And our results suggest, therefore, that large miners, these are the stable miners, and it's mostly smaller miners who either leave or enter the space.
What are the risks to the Bitcoin ecosystem when mining concentration is high?
So I think there are two main concerns, and they're somewhat related. So it's when concentration is high, it's easier for miners to collude, and therefore they can do several things. First, they can launch maybe an attack on the Bitcoin protocol. That may not be maybe the most important concern, because at the end, miners have some stake in the system, so they may not necessarily want to attack the protocol that feeds them. But miners, if there are few miners and they're concentrated, it becomes also easier to collude, for example, to decide on kind of future changes to the protocol, right? So as we discussed earlier in the talk, sometimes we might want to make changes to protocol to make it more efficient. But again, because miners are responsible for security of this protocol, we need to take into account miners' views on the protocol. And then, of course, if they already made investment, and as a result of the new changes, this investment will be lost, then they might be reluctant to implement these changes. So that's one concern. The other concern, it depends also on how kind of on the geographical concentration of miners, which we will maybe touch in the next question. So if miners are geographically concentrated, then it also becomes easier for some third party to take over of these miners or for the state to exercise control. And that also introduces some systemic risk to the system.
That's a crazy one to think about. That's like if all the miners hypothetically are in one country and that country's military comes in and just physically takes over the operation. That's kind of the, is that the risk that you're talking about?
That's the risk, yes. So in a way now, of course, with China before, kind of to preview, right, we know that a lot of mining activity had been concentrated in China. And then in principle, right, we might envision some scenarios that, for example, if there are some disagreements, right, so between two countries and China would want to maybe take control. In principle, it could happen. Well, now I think we are past that point maybe, but nevertheless.
Okay. So how did you estimate the geographic location of mining operations?
Yeah, so what we did is because we have very detailed data about miners, right, we can see not just the flow of Bitcoins to their addresses, but we also see where they cash out their rewards. So then the idea is that if they cash out in some exchanges which are prevalent in a particular geographical area, then it's a sign that a miner belongs to this area. So one limitation of our approach is that some exchanges they don't belong to one jurisdiction, for example, like Binance, cross jurisdiction. So in principle, miners who are in different parts of the world, they can send to these exchanges. But with this caveat in mind, we did this analysis and we arrived to a number which was consistent with prior estimates based on kind of analysis of IP addresses of miners which was supplied by mining pools. So we estimate that about pre-China ban of mining activity, about 70% of miners, individual miners, were located in China.
Interesting. So are there other concentrations of where miners are in addition to China?
What I just said, right, this mining concentration, that was pre-China ban. So what we see after the ban is that a lot of miners moved their operations to some other countries like Kazakhstan, Indonesia. Also now we see some activity in the United States. I think while mining farms are now not as concentrated as before, at least geographically not as concentrated, it's probably there are good reasons to believe that the ownership of, or maybe hasn't changed significantly. It's probably same people who previously controlled or previously owned those mining farms. They're still the owners of these funds. They just place them in different parts of the world. And again, we haven't done our analysis. We didn't extend our analysis yet to post-China ban, but also a priori, at least, it's unclear why concentration of miners should change, right? Because you would just move your operation elsewhere. But if you were a large miner, you probably still is a large miner.
You talked about the mining. So there's large miners, and the large miners operate through mining pools. Is that correct? So are the miners in any way required to do what the pools, required to do what the individual miners want, or could the mining pool?
That's, I think, it's an interesting question. So in principle, there were some arguments. We know that pools are concentrated and a lot of them are tied to China. But then some arguments were that pool concentration doesn't matter because if a particular pool misbehaves, then miners can move away from this misbehaving pool and kind of join some other pools. And if we think about, well, this kind of how easy to switch pools depends on actually on the power of individual miners versus pools, which again depends on the concentration, because it's also how easy to monitor a pool, right? So if we have tiny miners, it's very costly to monitor whether the pool, your pool kind of behaves or misbehaves. Larger miners, maybe it's easier to monitor, but at the same time, you also have more power over the pool, and also you can probably maybe dictate or a little bit to negotiate the fees with the pool or how the pool sets the fees. And I think also we know that actually it's difficult to start a pool if you do not have miners who would support your operation, right? Because like if you're a small pool, to grow to a large pool, right, kind of which composed of very small miners, nobody would want to join this pool because it doesn't provide any insurance. So usually pools are organized around large numbers. So I think we shouldn't think about pools and miners as completely independent entities. Most likely, again, at least the largest individual miners, they're connected to pools and they might be even maybe either directly related to this pools or maybe even also the owners of this pool.
Yeah, okay, interesting. So for your pinpointing the geographic location, you were looking at what the miners did with their mining rewards. In general, are miners holding on to their Bitcoin mining rewards?
The behavior we see on the blockchain is very heterogeneous. Some miners cash out their rewards almost immediately, but we see also some miners that accumulated very large sums. For example, we can see some miners accumulate like 20,000 of Bitcoins. So, but we study this investment behavior and cashing out behavior of miners in a separate project, but we are not yet ready to share the results. But it's an exciting area. The data allow us to do this analysis.
That does sound exciting.
It certainly does. So how does the concentration in mining power affect the security of smaller proof of work blockchains?
Yes. So again, it's a good question. So, and here what matters is actually the structure of, in a way, of the industry. Let's put it this way, right? So if we think about the security of protocol depends that the majority of mining power lies with kind of with good agents, right? That the agents don't misbehave. But at the same time, miners should be compensated for their work, right? So they have to be at least break even. So, and that should hold irrespective whether they hold 50% or 60% of the aggregate mining capacity, because again, we do not penalize, the protocol doesn't penalize the size of miners. So now, usually what we know is that miners have to incur some significant kind of to make initial investment, right? To be able to mine Bitcoin, they have to set up these farms, which again, expensive. So if we think about incentives to undermine the protocol, therefore, because we have this high fixed costs, then in principle, undermining is not very profitable, because if we undermine the protocol, it would be more difficult to recoup these fixed costs. So now, if we think about Bitcoin or Ethereum, so what happened for this, in the case of this protocol, is that as the price of Bitcoin increased, so did the aggregate capacity. And those protocols actually operated at almost a maximum capacity. So, well, partially because the price of Bitcoin overall was increasing, or at least it was profitable to mine most of the time. So, and as a result, the system was almost at the frontier of kind of this computing power. So the difficulty of attaining 51% was more like a technological problem rather than incentive problem by itself. Now, what happens is that, well, we see the emergence of some marketplaces where computing power can be bought. For example, places like NiceHash and others. So for Bitcoin, kind of the capacity of those marketplaces is rather small compared to the aggregate capacity of Bitcoin, maybe 1%, maybe 2%. So even if a third party tries to buy all the capacity of this available in these places, they would not be able to change kind of the Bitcoin system. However, if we now talking about smaller proof of work protocols, there 1% of the total Bitcoin capacity actually might be very often more than 100% of the total mining capacity available to these smaller pools. And therefore, what happens, or could happen, and actually even happened in the past, is that some third parties would rent some computing power from those marketplaces and use this computing power to launch an attack on smaller proof of work protocols such as Bitcoin Gold or Ethereum Classic. So, summarizing what I kind of was saying, we can see that large proof of work networks, they impose negative externality on the security of smaller proof of work protocols. And remember, we talked about some barriers to entry and limits to competition. So that's another factor that might, again, give advantage to larger networks. So because Bitcoin, again, it's secure, but this leftover of computing power, which is left from these large networks, it can be used to undermine, for example, the security of smaller networks and would make those networks less secure. And again, people might not necessarily want to join those networks.
Crazy. So not so easy to do a proof of work startup, I guess, securely.
Yeah, so but the same argument also applies to proof of stake protocols, because usually the security arguments, or at least the industry has been mostly concerned about so-called double spending transactions, where we spend a balance in a particular account twice, right? So, and then the idea is that, well, if people have a large stake in a particular protocols and it wouldn't, in place as a collateral their stake, they would not want to undermine this particular protocol because they would lose a large portion of their value compared to how much they can benefit from this double spending transaction. But this argument, it applies to double spending transactions, but it neglects the fact that, well, an attack may be not necessarily, or the benefit of an attack might not come necessarily from this double spending transactions, but rather large networks might try to undermine their rivals, right? And in this case, it's similar to large multinational companies we know who that sometimes buy their rivals, right, to shut down those rivals. We can imagine a scenario where large and established network would get some stake in the smaller rival, right? And then jeopardize, for example, they would try to, I don't know, do the double spending attack. But again, the benefit would come that people would just get concerned with the security of the smaller network and not use the smaller network.
Interesting. So they might be willing to take, I mean, it's like a loss leader product maybe. They're willing to take a loss on an attack to make the other network go away.
Essentially reduce future competition. Again, it's hypothetical, and I do not say that people necessarily would behave in this way, but it's a concern, let's put it this way.
Very interesting. How concentrated is the ownership of Bitcoin in the hands of individual investors?
Yes, so we show in the paper that it's actually quite concentrated. To put it in perspective, if we compare, for example, to the United States wealth distribution. So in the United States, we have estimated 1% of top 1% of people control about, I think it's, let me check, about 35% of wealth, and 0.1% control about 16% of wealth. So what we show that in Bitcoin ecosystem, even if we, using our conservative approach, where we do not count large investors which have direct ties, say, to large exchanges like Coinbase or MicroStrategy. So if we only use these individual holdings, we show that essentially 100% of investors control about 26% of all Bitcoin wealth. So it's almost 10 times concentration, 10 times larger compared to the concentration of wealth in the US. So the wealth is concentrated.
Interesting. So not exactly solving wealth inequality.
Yes, in a way, it depends what will happen, right? So it's
sure.
If we push for higher Bitcoin adoption, people who already control a quite significant amount of wealth, they might become even richer. Of course, at the same time, if Bitcoin price falls, right, it means that right now it's relatively small group of people will be affected. Again, there are a lot of Bitcoin users. And again, of course, some of them might, again, as for example, in the now infamous case of Luna, where holdings were also concentrated, right? A lot of people who are not necessarily rich also lost almost their savings. So it's not to say it's not important, right? But nevertheless, right now, again, holdings are concentrated.
All right. So the last question, based on everything we talked about, which has been pretty far-reaching, it's been a great conversation. Are, in your opinion, cryptocurrencies living up to their promise of democratizing financial services?
I think a fair answer would be not yet. So we do not see that cryptocurrencies or decentralized finance solve a full range of problems that traditional finance solves. They rather focus on some narrow set of problems, mostly focused around trading. We also have narrow banking that allows to obtain leverage in the transactions, which, again, a lot of observers claim that it's mostly used for trading. It might be that, again, in the future, the underlying technology would be able to bring down the costs of transactions. And through this process, we again, arrive to a more efficient financial system. But again, as we talked today, it's less clear that to arrive to this point, we really need permissionless protocols and anonymous access, which creates some other problems like enforcement, etc., and adherence to KYC norms. So, so therefore, I think it's almost. I think I'm not very different from what other people in the industry would say, is that yes, there is a promise, but we do not fully see kind of a clear path how this promise will be fulfilled in the future. But hopefully.
Awesome. All right, Igor, thanks a lot. This has been fantastic.
Thank you, Benjamin.
Thanks, Igor. That's
Cameron.
great. Great to meet you.